Hey guys, this is Kevin at Movement Mortgage, and today we're going to be talking about a very, very important topic. It's interest rates. So Veterans Day is coming up, so I'm sporting my military movement swag, but here nor there. Interest rates. So I get this question a lot, and the question is always, how do interest rates work? And people always want to know, should you shop your lender to find the best interest rate? How did I get the interest rate that was given to me? Can I buy down my interest rate with points? What I'm going to be breaking down for you today is how interest rates come out to you, the client, and then what you can do from there. Okay, so we'll keep it super simple. So the way to understand this is interest rates are basically on a number line. And you can see here we have 5%, we have 6%, we have 7% and 8%. So very typical number line. Okay, now the loan program, meaning if you're going FHA, VA, let's see, USDA, conventional, whatever, the loan program is going to dictate where you fall on this number line for sure. The down payment, or what we lenders call the loan to value ratio, meaning how much you're borrowing versus how much the home is worth. So down payment, and then also your credit score and the overall, basically the composition of your file as an entire mortgage application. That's all going to dictate whether you have a high credit score, low credit score, so on and so forth. But let's just say for the sake of argument that you applied, and we're not going to get into the minutia of which program, down payment, and credit score lands you where. Let's just assume you landed right here on the number line, okay? So let's say the interest rate that came out to you was 6.5%. You're right here between 6 and 7. Lenders call this par, or a no-cost rate. So on this side of the number line, we have the interest rates. On this side of the number line, what we're gonna put is points, the cost or the rebate that comes to you. So when lenders pull pricing for your loan scenario, what they're gonna see is where you land on that spectrum, that number line, and we call that 0. Now, if you go down the spectrum, the number line, you'll start to see that there are costs associated with it, and they'll be at like various tick marks, okay? So if you wanted to buy your rate down to 6%, if you wanted to buy your rate down to 5%, there's costs associated with that. So let's say to go from 6.5 to 6, that was an $800 cost, right? And then if you wanted to go down to 5%, let's say that was maybe a $4,000 cost, all right? So this is how points work. There's the number you're assigned based on the loan program, loan to value, down payment, your credit score, the overall makeup of the file. And then if you wanted to pay points, you can do that. And this is free and clear information for you guys. This is across the board at any lending outfit. If a lender's coming to you and saying, yeah, I can get you 5.5 or I can get you 6, just know that wherever you start, what we call par, you can always buy down your interest rate from there, okay? It may be expensive to do so. It may not make sense for your current scenario. Like if you're not gonna be in the home very long, it doesn't make sense to buy your rate down very much because then your break-even point is too far out into the future. So that's that section. Now, going this way, if you were to go up on the number line, once again, we have the same tick marks, okay? But in this side, because you started at 6.5, given your loan program, down payment, all that good stuff, you started right here, no cost, 6.5. Let's say that you were kind of a wild person and you wanted to get a rebate. So if you were to go to 7%, that would actually be $800 off your closing costs. And I'm just using the same numbers here. And if you went to 8%, let's say that was $4,000 off your closing costs, okay? So why would you do this? Well, if you were an investor, you were doing a fix and flip or something like that, again, knowing you're not gonna be in the home for a long time, you bought the home, you were light on cash to close, you'll take a higher rate, you'll take the rebate, take the money off your cash to close, and then when you sell the home in a year, it doesn't matter what the interest rate is because you need to be out of it in time. So there are very well instances where you would take a higher rate and you would lower your overall cash to close. 9 times out of 10 though, I would say people are always interested in this side of the spectrum. They would say, now, what can I buy my rate down to so that I can save month to month on the mortgage, right? So that makes sense. So just know, to recap, when you get an interest rate from a lender, it's going to depend on the loan program. It's going to depend on the loan to value ratio, your down payment, your credit score, the overall quality of the file. and you're gonna land on a spectrum of rates. You're never just given a rate. So you're gonna come out on this number line somewhere, we call that par, but that is a no cost rate. Now, if you wanted to buy your rate down with points, you can do that. Just does it make sense? How long are you gonna be in the home? What's that break-even analysis look like? Or do you want to rebate? Are you light on cash to close and you need to take some money off the overall cash to close figures? Take the higher rate, lower that. Just know that as you lower your rate or raise your rate, your debt to income ratios will go up and down accordingly. So lowering your rate lowers your ratios, but increases your closing costs. Raising the interest rate is going to lower your closing costs, but increase your debt to income ratios. Now, another thing I want to talk about is when people talk about shopping lenders, what they don't ever talk about is why. Back in the day, in the prior to recession, 08, 09, the housing crash, everybody shopped lenders because they wanted the best rate. So following this same number line, okay, I want to talk about compensation of loan officers and how things have changed. Back in the days prior to the 08 housing crash, all these rebates that you see here on this side of the spectrum, so again, starting from the no cost points, if I was to talk you into a 7% interest rate, now rather than $800 coming off your closing costs, that would actually be my commission. So this is how loan officers back in the day, not entirely, but a part of how they were compensated. They were compensated based on the interest rate you received. You could see how it would be easy for you to get taken advantage of back then. If you didn't understand this system, if you didn't understand the number line, how interest rates work, it would be easy for me to talk you into a 7% interest rate and get that money back towards me. So when people said shop your lender, shop your lender, shop your lender, it's because it was a way to keep lenders honest. And now when you choose a higher interest rate, this is not my commission, this is not the lender's commission, this goes back to you, the consumer. Today, we are not compensated based on interest rate, we are not compensated based on loan program, so whether you go conventional or FHA, we don't get compensated any differently. So you can rest assured that in today's world, you can shop your lenders. I'm not telling you not to shop your lenders, I'm just telling you to understand why. You really do want to understand this, because it takes out a lot of the distrust that's there that our industry basically sowed for years. So now you can rest a little easier knowing that lenders aren't absolutely out to get you, and that lenders are not looking out for themselves, looking out for their commission checks. Okay, so hopefully that helps. But again, that's how interest rates work overall. If you have any questions on how loan officers are compensated, if you have any questions on interest rates, and you want me to break this down in another scenario, I'd be happy to do so. If any of you have loan estimates from different loan officers you want to compare, I have a video on the YouTube channels. It's called How to Review a Loan Estimate. I also have one called How to Review Your Closing Disclosure. This is from the CFPB's website. Great video. I basically walk you through what you need to do to compare not only just interest rates, but also costs. And another thing too on that note, when you're shopping lenders, is it's not all about the interest rate. It's kind of like splitting hairs with how competitive lenders are on interest rate. You should most definitely be shopping lenders based on service. Right? Are you calling a 1-800, I'm not going to answer you? Or are you calling Kevin's personal cell phone and he will get back to you if he hasn't already picked up the phone, right? Are you working with a lender who's texting you back and getting you the pre-approvals at a moment's notice? Are your agents happy with that lender and working with them? This is all a part of the success on how we close on time. So when you're shopping lenders, sure, you can take a look at interest rates, you can get a couple quotes, but you should most definitely be paying attention to the quality and the service of the lender. Thanks, guys. See you in the next one.